Hi, thanks so much for joining in. I'm Alex Matthew and this is Your Money Matters on NDTV Profit, because for us at NDTV Profit, your money matters. It's really simple. We discuss everything related to money, not just your investments, but also your expenses on things like travel, luxury, and even health. On today's episode, I want to talk about something that often gets ignored. We stress about the interest that we earn on fixed deposits and other investments, but not enough about what we're paying to the bank. I want to get you to think about how you can stop banks from earning so much from you. And later on in the show, one of our lucky viewers will join in to discuss his most important financial goal, and my guest today will help him achieve that goal and to plan for it. Joining me today is Harshvardhan Roongta, Certified Financial Planner and the co-founder of Roongta Securities. Harsh, thanks so much for taking the time.
My pleasure, Alex. It's always good to be in discussing personal finance with you.
Yeah, and this is a brand new show. Thanks so much for being on the first episode.
My pleasure. Entirely my pleasure.
So, do you agree that people often don't entirely factor in the cost of interest?
Absolutely. In fact, Alex, if you look at the situation right now, we would see people are judging the affordability of a product based on the quantum of EMI, not on the total cost of the product.
Yes.
Now, I'll give you an example. I mean, we've seen so many people, upgrading their cars, right? Now, how do they judge what is the cost of the car that they need to buy with the EMI that they can afford? So say an individual says, I can afford say 35,000 rupees EMI. So they will look for an EMI equivalent to 35,000, nothing to do with the cost of the car. So if the EMI does not fit into a 3-year loan, they'll extend the loan to say 5 years.
Right.
But they'll keep the car, the cost of the car will be much higher than what they had originally anticipated. So what happens in this case? So initially you had a budget of say you would want to buy a car worth 15 lakhs.
Yes.
And for whatever reasons, the EMI fits into say 35,000. Now you walk into the showroom and you'll have a salesman telling you that, look, why are you looking at a 15 lakh car? Why don't I give you something which is say an upgraded version of this, which comes say about 20 lakhs. Now, if you were to compute the EMI over 3 years, it's certainly not going to be 35,000.
Correct.
So what do you do in that case? Now you say, okay, if you can afford 35,000, let me extend the loan period to 5 years. So you say, okay, fine, that suits, as long as I can pay 35,000 every month. But now in this bargain, you've actually increased your spend from 15 lakhs to 20 lakhs.
Right. And the interest cost is significantly higher.
Absolutely. Let me explain that to you with another very common example of a home loan. I mean, if buying a house has been on the wish list of almost everybody,
yeah.
Now, if you were to use that as an example and you take the numbers out of that, so say suppose you're taking a loan of 1 crore, the tenure being 20 years, and your rate of interest is 9%.
Sure.
Your EMI in this context will come to about 90,000 rupees.
Right.
Now, you have to pay 90,000 rupees over 20 years. So that's 240 installments.
Correct.
The total outflow, 90,000 into 240, is 2 crores and 16 lakhs.
Right. That's more than double.
Yeah, against a loan of 1 crore.
Yeah.
So 1 crore is your principal that you've repaid, and 1 crore 16 lakhs is the interest that you're paying. So the cost of your house has become more than double.
Yes.
Okay, so I'm not saying do not buy a home loan, do not buy a house on loan. I'm not going to that. Just extrapolate this onto discretionary spends like a car or a holiday. We see people, taking loans for buying cars which are way beyond their means. We're seeing people going on holidays on EMIs. So I think if you were to compute the interest that you're paying for discretionary spends and depreciating assets like cars, so then you would possibly know what kind of impact you're having. So it's very, very misjudging for people to evaluate their spends based on the affordability of EMI.
Are there good interest costs and bad interest costs?
Yes, of course. So any product that is productive in nature, say for example, house. A house is something that you possibly live in. It could also very closely be related to investments.
Sure.
Over a period of time, you believe that at least you should be able to get your cost, if not profit.
It's usually an appreciating asset.
It's usually an appreciating asset. So, I mean, I wouldn't put, and house mainly, as I said, roti, kapda, makan. I mean, these are the things that, and if you're buying a house for investment purpose, then you have to evaluate it independently accordingly. But if you're buying a house for your own self, being an appreciating asset, if at all, I mean, I don't think that would be going into the unproductive area.
Okay.
However, going on a holiday on EMIs on a loan, I don't think I can even come to terms to accept it by any means. I mean, and that is what...
Or clothes, for that matter.
Yeah.
You said roti kapda, I know. But
no, but designer clothes, I mean, you don't buy designer clothes on EMIs and on loans, right? That is not... So roti kapda makan would essentially mean your basic living, by living standards. And I don't think you would have a problem covering yourself up with regular clothes, and you don't need no loans for that.
Right.
But given the culture that we are in right now, the concerns are that we are tending to spend more than what we can afford. The aspirational value of things that we want to own is much more than the practical side of the brain that works to say that, look, you're not supposed to do that. So I think that mismatch at one point in time will be very fatal. And that is when you get into a debt trap. That is when you get into those lifestyle traps that once you've upgraded your lifestyle, you cannot go down again. Like if you've started moving into an ultra luxury car, and then suddenly after the next round, you're going down to a regular sedan, I don't think that the society is going to like it. And you're going to be worried about that.
So there are certain, and you know, I often talk about thumb rules, I know, but I try to contextualize it and make it usable by everybody. And there are reasons why these thumb rules exist. There are thumb rules about what your EMI should be as a percentage of your overall income. Why does that exist?
So see, it's basic rules and basic principles. If you're earning, say, 100 rupees, there are going to be certain expenses going to be required for your day-to-day living expenses. Like, I mean, you're going to have food, clothing, shelter, as I said. So essentially, if you notice, I mean, if you're in a good situation, if your income is beyond and say about ₹1 lakh per month, then your basic living expenses would be at least 50% of that.
Sure.
Okay, if you're earning only 15,000-20,000 rupees a month, then everything goes towards living expenses.
And that would include rent and your food and all of that.
Absolutely. So there is going to be one basic expense that you're going to incur based on every city that you live in. I mean, each city will have the different amounts. But unless you're earning at least ₹1 lakh a month, I don't think you'll have surplus left, quite honestly. But in case you're earning more than 1 lakh, that is the time you get into those areas of loans and EMIs, because you believe that 50% of that would be your basic expenses. Even if you don't do anything fancy, in a city like Mumbai, I mean, I don't think you can survive with less than ₹1 lakh a month as an income in that context.
I mean, a lot of people do, but at the same time, they have to limit what they're spending on.
Exactly. So 50% of your income would essentially be for your day-to-day living expenses. Rest for 50% that you have, that can be best allocated towards EMIs. Because if you're going to be allocating more than 50% of your income towards EMIs, then what are you going to be left with for survival purposes?
Okay.
So in that context, ensure that your EMIs are never more than 50% of your take-home salary. And
do you try and ensure that you don't take unproductive EMIs? Is that it? Because a lot of people say, for the purposes of your credit score, which is an argument that I've heard a lot, right? You take a loan to up your credit score for that moment when you need to take a big loan so that you get a good rate. I think that's a very foolish way of even trying to induce a person to take a loan, quite honestly. I mean, it's like telling a pure vegetarian that you need to have meat to have access to protein. I mean, I don't think it works like that. And you have a lot of options available to you. A lot of options. I mean, you could do just regular credit card transactions and you would possibly have a credit score there. Because it's always struck me as really odd that the banking system looks at somebody with no credit history as a bad borrower or potentially bad borrower because they don't have a history. From my perspective, somebody's not taken a loan because they've never needed it and they've managed their lives very well by apportioning and living within their means. And you know, they're perfectly fine. But a bank manager would say, hey, or a credit a reviewer would say, look, you don't have a credit history, so you're not going to get the best possible score. So, you know, it's a bit unfortunate, but, you know, being fair to the bankers as well, I mean, if there is no track record of you, there's no credit score, so you don't want to stick out your neck to say that, look, I'm the first one to take exposure to such a person. But like you said, in your example on the vegetarian versus non-vegetarian protein sources, ultimately you have cash flows, right? And your bank is going to judge your ability to pay based on cash flow. So there should be a way. And that argument is false. No, so this is fair. So exactly. Now coming to the GST, let me bring GST in. So all those self-employed individuals or small businesses, I mean, you know, right now banks can evaluate their turnover based on the GST returns that they file. Yeah. So yes, there are multiple other sources.
But that's an excuse if an individual gives, say that I'm taking a loan only to build a credit history. Sure. I don't think that is even holding any good stead in anybody's argument. So if you're fooling yourself by saying that, look, I'm taking a loan right now so that if I want to take a loan later on, I will have a credit history. No, I think don't even get into that zone.
And the kind of loans that people get into, therefore, are your relatively smaller ticket loans. Your credit card, of course, they get into credit card spends. Hopefully, people are not getting into credit card debt. What are the big no-nos? Personal debt, unsecured, and credit card debt. Would you say that big no-nos?
Absolutely. To begin with, to roll over a credit card outstanding is one of the most, unproductive or a most, I would say, a biggest mistake that a person could do is to roll over your credit card outstandings, because that entails an interest of almost 30 to 40%.
Yes.
So you don't want to pay that kind of and then again the credit history gets negatively impacted. Okay, so that's one that you avoid by all means. The other is the personal loans and the unsecured loans, because they come at a higher interest rate. Invariably, they would be in between 14 to 18% is what you're going to pay for an unsecured or a personal loan. The third, of course, as much as anybody would say that these are zero interest
buy
EMIs,
now, pay later.
Buy now, pay later. Those websites will entice you to say that you spend now, pay later, and these are zero interest rate. Nothing in life comes for free.
Yeah.
Okay, they're very smartly packaged offers to you that you don't realize that you're actually you're paying for it eventually. So these travel portals where you go in and you say that you go on a luxurious holiday, exotic holiday, and you just pay so much EMI. I think that's the problem that people are falling into. To say that, look, I'll go on a holiday now and pay it over 6 months out of my salary. I don't think, why don't you go for a holiday after 6 months?
Yeah.
I mean, accumulate it and save it up and spend, because holiday is certainly not a thing that you'd want to spend by taking a loan. I don't think that is even reasonably making any...
Set up a travel fund.
Travel fund, and travel is not something that you need to take a loan for. I mean, if you're falling into that zone, then there is something that you need to be careful about. You need some kind of guidance and consultation to come back out of this, because if you're going to spend on a holiday out of loan, that means your other priorities that are there in life are not going to be taken care of.
Okay, so we've discussed the quantum that your EMI should be, not more than in your income. We've discussed what type of loans you can consider taking. Let's also consider, if you have loans existing, how do you knock them off? And how do you dramatically reduce your interest cost? Obviously, by paying lump sums, but some people have also talked about paying one extra EMI every year. It's a simple concept. A lot of people diss it on social media. I've seen this as well. But it is a powerful concept when it works.
Absolutely. So it's nothing, no rocket science. I mean, we as Indians have been, have grown up with these money habits.
Yes.
Quite honestly, even if you're a family of engineers, still your parents will be telling you to be prudent with your money.
Yeah.
So they will tell you that, don't spend XYZ amount. If you've taken a loan, try and repay. So that every time that a person gets an increment in the salary, why don't you ever consider increasing your EMI? Okay, so you fixed your EMI at the beginning of taking the loan, and that is for, say, probably 15, 20 years. Why don't you go back to your banker and say, look, I want to increase my EMI by 10%.
So bankers are not going to thank me for saying this, but a lot of them will say, increase your tenure and not your EMI, because over the course of a longer tenure, your interest cost goes up.
Absolutely.
So the bank earns more.
We just discussed this. Over a period of 20 years on a loan of 1 crore, you're paying 1 crore 16 lakhs as interest.
Yeah.
So obviously, you're paying more than the principal that you borrowed. So you need to go back to the bank and say, look, I want to increase my EMI by 10%. Let the interest rate be constant. The tenor be constant. Let me just increase my EMI. The other concept very popularly is that instead of 12 EMIs in a year, you pay 13 EMIs.
Yes.
Because you get a bonus, you get a performance-linked incentive, you get those lump sums. So just go and prepay, one additional EMI every year. You see the magic when their tenure reduces considerably by just one additional EMI. Or additionally, when the interest rates are going to fall, and then an offer comes from the bank saying that, look, hey, the interest rate has fallen. Do you want to reduce your EMI? No, you keep your EMI constant. So automatically the tenure of the loan will come down. So you'll be able to repay that loan faster. The net interest burden on you will come down.
Yeah.
So of course you need to evaluate well within whether it's a productive loan or an unproductive loan, all those kind of things.
The last thing I want to talk about is a lot of people are still on the marginal cost of funds lending rate, MCLR, which was used after the base rate regime, because it was felt at that time by the Reserve Bank of India that banks were not passing on the interest cuts and raises that they were doing, more raises than cuts, or more cuts than raises rather. And now it is the benchmark linked prime lending rate. And so therefore, a lot of people are being incentivized or being asked by their banks to switch over to the benchmark linked rate because it resets every month.
Correct.
How do you decide when you want to shift? Because MCLR does not reset very quickly.
So RBI has been prudent on this context to whip the banks on this to say that, look, you keep coming to us and saying the interest rates are high because of which XYZ, we're not able to lend and all those things. The moment RBI reduces interest rates, they'll be very, very notorious in passing it down to the...
Very quickly.
Yeah, they're very notorious in that. Let me put it without mincing words. I mean, they don't very, wholeheartedly pass it on to the...
When they raise interest rates, they do very quickly, and when it's going down, they don't.
They don't do that at all.
Yeah.
So it's on the borrower to be prudent enough to go back to the bank and also flash the credit score that you have, that, look, I've been honest and I've been paying everything well. Then why aren't you offering that benefit to me?
Yes.
Now, the two choices, the banks do not pass on entirely. The other is, then otherwise you have to move your loan to another...
You can shop for a loan.
Yes, but there's a cost to that. So there's a processing fee. Then you have to evaluate whether that cost of moving the loan...
It's usually a percentage of the remaining
principal. About 0.25% odd. Plus there is a process to follow, right? There's there's going to be a whole lot of things to do. So it's not the most ideal situations to be in, right? Because there is a cost incurred. So then you have to get into the cost benefit analysis.
Yeah.
That if I'm incurring that lump sum cost against the interest that I'm going to save over a residual period of time, is it worth it or not? So moving to anything that helps you save interest, okay, and if it's more efficient way of transmitting the reduction in interest rate to the end borrower, I think you should be prudent enough in doing that. So if you're asking your borrower to move from MCLR to the benchmark linked rate, yes, I mean, most certainly go ahead and ask your bank to do that for you. If there is a cost, sit back and evaluate whether that cost benefit analysis makes sense or not. If it does make sense, then please do that, because every interest that you're going to save is as good as money earned.
Absolutely.
Right? And over a long period of time, it's like compounding. So you're compounding a negative impact of high interest rate. So might as well have it reduced to as much as you can.
Yeah, we often talk about compound interest and the compounding of your wealth over a period of time. Not very often do we talk about the compounding cost of interest. All right, so Harsh, hopefully we've given our viewers some perspective on how to manage their interest cost, because really we speak about compound interest and what you earn, but often you don't talk about what you incur, and that is also compounding, as Harsh has pointed out. Now, it's time for a special segment on this show, and I like to call it Money Monday. This is where we speak to one lucky viewer and we ask them what their foremost financial goal is. My guest today is Kamal Sharma. He's joining us from New Delhi. Kamal, thanks so much for joining me today. And what is the goal that you've selected? You've shared with me that you want to retire in 10 years. You are 34 years old. Why do you want to retire so early?
Okay, so thank you, Alex. So currently I'm 34, sir, and I want to retire at an age of 45. So by that time, so it's been 11 approximately years.
Right.
I want a corpus of 50 lakh for something to build. I have a property of mine in my hometown, right? And I want to invest some money wherein, so I heard of a lot of things about SWP. I wanted to know the entire concept of it. And if I can invest some money for 11 years so that I can get a lakh or 1.25 lakh every month for managing my expenses. So that's what the idea is.
Okay, so Harsh is going to help you out, and please know that over the course of the next few minutes, the stage is set for you to ask as many questions to Harsh as possible. I'm just going to lay the context and then open it up. So you were 34, your goal is to retire in 11 years at the age of 45. You are married, your wife is also earning an income. Your monthly income is 2 lakh rupees, your expenses stand at 1.25 lakh rupees, and your monthly investments are at 55,000 rupees. You're currently investing in mutual funds as well as in the Sukanya Samriddhi scheme and the voluntary provident fund. So you're upping the amount that you put in the provident fund every month. The Provident Fund corpus currently stands at 15 lakh, savings account is 1 lakh, mutual funds is 5.5 lakh rupees. You live in your own flat, and your current liabilities stand at a 39 lakh home loan, a vehicle loan of 6.5 lakh, and a personal loan of 1 lakh. So I've set the context. Harsh, over to you.
Yeah, hi Kamal. Very quickly, if I just do some basic calculations, okay, because you mentioned that you want to retire at the age of 45. Right. And so there is going to be required, and you said you need every month about 1.25 lakhs, the amount that you're spending today. So if I just do some basic calculation, assuming a 7% inflation, so that 1.25 lakhs, we are taking it adjusted to inflation at the age of 45, and thereafter, I'm taking a life expectancy of approximately 80 years. So what I'm only trying to do by this exercise is to ensure that you have a cash flow up till your age of 80. Okay?
Okay.
And if you were to look at, as I said, the monthly expense of 1.25 lakhs, you'll require approximately 10 crores at your age of 45. Okay? If you can accumulate that corpus of 10 crores by the age of 45, that means that you can look at retirement, assuming that you'll get an inflation adjusted cash flow of 1.25 lakhs every month up to your age of 80. At 80, the entire corpus will exhaust. Okay, so you'll not be left with anything at your age of 80. Now, to accumulate this corpus over a period of 11 years, if I assume an investment return of approximately 12%, every month you will have to contribute about 3.6 lakh rupees. So wherein you're currently investing approximately 50 to 60,000 per month, this per month investment goes up and goes up to 3.6 lakhs per month.
I'm curious about what you think, Kamal. When Harsh says 10 crore is what you need to set aside over the next 11 years, is that a number that you had contemplated?
No, 10 crore is way beyond my expectation. But at the same time, you said 80 years of age, sir. I don't think so we'll be able to live up to that. Considering we are staying in Delhi and Delhi is so polluted, going by the trend, we're gonna die by 65. So that's what I am aiming. I'll be alive till 65. So that's how I'm calculating.
But okay, Kamal.
So down the line, 20 years. If I start from 45, so if you can calculate that and probably tell me then.
Okay, so that's a fair point. But here's my question to you, Kamal.
Yeah.
You're aiming for 65,
Right.
but assuming that there are a lot of technological changes and we move towards cleaner energy and various other things take place, which we don't know right now, right?
Okay.
What if your life expectancy is not 65 and is actually 80? At that stage, you're not going to have the ability to say, hey, I need more money, right? Because you're not going to be able to go back to work. Is that not difficult?
So, Alex, in that case, I'll increase my retirement life. I'll take retirement at the age of 50, or I'll probably go up to 55 in that case.
So you'd be willing to stretch. Okay, Harsh, I think that is what you're talking about.
Yeah, yes. So in fact, Kamal, I also want to highlight this point. So while you mentioned that you don't see yourself living beyond 65, I wish and I pray to God that you have a long life. I mean, you should not think of it in that direction. But nevertheless, from a planning standpoint, when you plan for things, plan as if you're going to live forever. So in case you were to live, as Alex said, that you go beyond 65, then what are you going to do at that point in time? It's always good to have a provision up to age 80. And in case something happens earlier, then fine, then you got something left for your family to inherit in that case. Imagine a situation that in this case, I'm even more concerned, given the advancement in medical sciences, given an advancement of technology in that context that doctors don't let you die. They'll put you on ventilator till the time they can. So imagine a situation where you go beyond 80. So I was worried about a question you would throw at me saying that, hey, this is only till 80. What if I live beyond 80? So you pleasantly surprised me, at least in that context, to say that 80 is way beyond your expectation. But anyways, now since you also mentioned that you're willing to extend your retirement age, so I did another set of calculation for you too, which brings things within the comfort levels. So if not 50, I'm going to be disappointing you to say that, look, why don't you just go all, the entire mile, you walk the entire mile, say 58 or 60. So if you were to retire at 60, then what the scenario looks like. Okay. Pardon me to, absolutely, dishearten you with this kind of extended work life. But in case you were going to work until 60, then the retirement corpus that you need at that point in time is not 10 crores, but it's going to go up to 17.5 crores. Okay, but don't be disheartened. Let me give you the good news now. Now, to accumulate this 17.5 crores every month in place of 3.6 lakhs, which was the earlier case, you need to now only put 83,000 rupees per month up till your age of 60 to accumulate 17.5 crores. So 83,000 rupees investing every month is still within reach, as I understand. If not immediately today, but going 1 or 2 years down the line, as your income increases, make sure that you increase your SIPs. So that seems to be a much better equation for you at this juncture.
Is that possible for you, Kamal?
No, definitely. Down the line, 1 or 2 years, that is possible. I can manage that.
Fantastic. And of course, what Harsh has not spoken about is you have 2 lakhs of income. We've just on this show discussed how you can get rid of certain loans. If you can get some of your loans out of the way, and if you can increase the amount that you set aside, you can actually shrink the time that you need to work quite considerably, because you have a sizable income. If you increase the amount of that income that you set aside every month, I'm sure you can save a bigger corpus. But it's been a fascinating conversation. Thank you so much for that glimpse into your life, and hopefully this conversation has been beneficial to you.
Definitely, Alex. Definitely.
Thank you so much.
Thank you so much.
Thanks so much, Kamal, and thanks so much, Harsh, for joining us in the studio. And thank you for watching the first episode of Your Money Matters. Do stay tuned. This is NDTV Profit.